But today that debt to GDP is at 125%, and public debt is 35 trillion and counting. You have to think about that. It's not just the extraordinary explosion in the debt, the exponential explosion. It's also the pace of it. It took us 220 years in the United States to get to 11 trillion in public debt. And in the last 4 years, we've added another 11 trillion in public debt. So again, these aren't meant to just be statistics that you throw out there to try and look clever. The ramifications are massive. And the Congressional Budget Office in the US is already, projecting another, I think, 20 trillion in IOUs in the next 10 years. That's crazy. And you can talk about fiscal spending. I don't think it's going to come down that much. And in the next 3 years, we have to roll over about 15.5 trillion in US Treasuries at a higher yield, despite the coupon being fixed at 2.3. The yields are around 5%. So the yields are double the sticker price. So where does that money come from to refinance these grotesque debt levels in just the US, which is the home of the world reserve currency and the tier one asset 10-year US Treasury? You can't ignore the reality of what debt does to these economies and the ripple effects it has on currencies and markets. So when you just look at that and what that's done, everything starts there and everything ends there. Whether we talk about currencies, precious metals, equities, credits, it all comes back to how that debt has central banks trapped, how that debt has the Fed trapped in particular, and what that means to the man on the street, what that means to the bottom 90% or even the top 10% in the wealth inequality spectrum, the inflationary effects of that, the currency debasement effects of that. And then if you just look at the raw numbers on recession data, whether it's bankruptcies, unemployment levels, U6 unemployment levels, debt-driven CPI growth, which is pretty anemic, it's not meant to be negative for negative sake, but I can't be possibly bullish right now. I don't know how anyone can. That doesn't mean markets can't continue to go up, but you're measuring it against a currency that's going down. So there's just so many overlapping themes, Anthony. But to make a long answer even longer, the debt really defines the global macro right now, and it defines all the asset classes that we discuss under it, and it even defines some of the geopolitical desperation we're seeing in the world. So, and since the debt problem isn't going away anytime soon, I don't think the macroeconomic problems or the currency problems or the bubble asset risks are going away anytime soon either. So we have to just, again, the facts haven't changed; they're just getting worse and worse, and so the themes stay the same for me. And we can unpack those at the individual level, but we're now trapped. We're trying as a country and as a nation and as a world hitting 400 trillion in debt in the next few years. That's literally like trying to swim with a cannonball strapped to your ankle. Growth is now, I think, mathematically impossible, whether you're reading David Hume from the 1750s, or Reinhardt and Rogoff, von Mises, or simple common sense from Ernest Hemingway, or even our own personal common sense, whether you're a family, a company, or a nation. When you're debt levels are 3 times your income levels and you're strapped, I don't know how you can project growth optimistically, even in a political environment where there's a lot of optimism out there to get elected. I think the Fed, the White House, the Parliament, the ECB, et cetera, they're all trapped, and they're all desperately trying to reduce rates to save their bond market at the expense of their currency market.